Pension Fund Investment Meeting. Today is 9/17/2014. It is about 7 minutes after 10. We're at New York City Controller's Office, 1 Center Street, room 530, New York, New York. Do we have a roll call, trustees? Lee? There has to be a little louder than that. Maybe I should do it. Antonio Rodriguez?
Here. Fine.
Okay. Susanna Vickers?
Here.
Caroline Wolford?
Here.
Stephen Cassidy?
James Levin is Stephen Cassidy's proxies.
James Slevin?
Here.
Robert Straub? Or it's not Robert Straub?
Edward Brown.
Edward Brown. Did we get his paperwork? Did we get his paperwork?
I don't know.
It doesn't matter.
Yeah.
I will send you an email later.
So you have Edward Brown's?
I had John Kelly as Brown's proxy.
Okay, and we'll send in a notification, we will backdate it, et cetera. Okay. James McGowan?
Here.
John Farina?
Yeah.
Paul Farrow?
Yeah.
Tom Phelan is replacing Sean O'Connor. It's his first meeting for Marine Engineer. You here, right?
Yes, sir.
Okay. And Doug White. All right. We have 24 votes. We can start the meeting.
Anthony Brown's proxy.
I'm sorry, I missed John Kelly. John Kelly, is he here?
Yes, sir.
Thank you. Okay, we have 24 votes. We can start the meeting. We'll start with the public agenda.
Thanks very much. We're happy to be here today. We have a lot to get through, and so we're going to try to get through the agenda very crisply, particularly the economic overview part. Starting with the fiscal year reports and the quarterly report. If you turn to page 8 of the quarterly book. You get the total numbers for the fire department portfolio versus benchmark. The fiscal year ended June. The fire department portfolio was up 17.39%. And that was favorable relative to the manager's benchmark of 16.24%. So the bottom line on an overall basis, it was a good year relative to the benchmark that we have, and it was a great year relative to the 7% assumed rate of return. Make no mistake about it, the 7% assumed rate of return is still a difficult bogey to achieve over a long period of time for a large pension fund like this. And we should not think that we can get it every year. In fact, I would suggest that at 17%, we borrowed from the future a bit, and we should look at it as such. And we'll continue to manage the fund for an environment where 7% is a very ambitious goal to achieve. With that, I'm going to turn it over to Martin, who's going to take you through the economic overview, which will set the backdrop for discussions later about our rebalancing policy and the annual plans that you'll hear today from the asset class heads. Now, although we're not asking for formal approval for these annual plans, we would like you to come in, particularly if you have discomfort with something that we're doing, so that we know to slow down in that aspect of our plan and come to you very carefully with a lot of evidence and so forth. So we are looking for feedback, if not formal approval. With that, let me turn it over to Martin to take you through the economic backdrop.
So I'm going to be going through the quarterly report, but I'm also going to be referring on occasion to some of the slides in this color book. So first we'll start with the full quarterly report. So let's start with page 8. As Scott mentioned, returns on an absolute basis were really good. nearly 17.4%. And not only was it good on an absolute basis, but it was good on a relative basis. You beat the benchmark by well over 100 basis points. And we'll go through that in a moment, what went right. The overview, if you take a look at 2013, calendar year 2013, the U.S. equity markets as measured by the Russell 3000 went up over 30%. Much of that was driven by the Fed and other factors. But not only did the equity markets do well in the U.S., but because of that, other risky asset classes did well. If you remember and go back to in 2013, May and June, June was a very difficult month, it was a down month, and that was when the Fed started talking about tapering their quantitative easing program. Quantitative easing, to remind you, is where the Federal Reserve was purchasing bonds, treasuries, and mortgage-backed securities to help lower interest rates, just to help stimulate the economy. The purchases were $85 billion a month, and the Treasury and the Fed's balance sheet was over $3 trillion at that point. As we go through some of the charts in this book, you'll see that the economic recovery is definitely underway, but it is slow and not as robust as compared to prior U.S. economic recoveries. And that's why quantitative easing was going on. When the Fed announced that tapering, and that entered our lexicon, the word tapering, back in May and June, the markets didn't take it very well, and it was an incredibly volatile month a year ago in June, not this fiscal year, but just before that. And what happened was, as you might expect, supply and demand and volatility, interest rates went up. When the Fed announced that they're no longer going to be purchasing as much, well, that means, well, who's going to purchase it? So prices went down and yields went up. And yields at the beginning of the fiscal year were much higher. In fact, if you turn, again, now to the color book of charts, to page, pardon me, 1 second.
Everyone have a copy?
Yeah, if you don't have a copy, let me know. Page 20, need a copy?
Page 20, exactly.
Page 20. This is a page that shows the last 5 years of U.S. 10-year Treasury rates. And if you take a look in 2013, the last piece before 2014, right in the middle of the year, there was a giant spike up from the mid-ones to nearly 3%. That is a large move considering the duration on 10-year Treasuries is in the 8s. And what that means is 1% move up in yields means you lose 8% for owning those treasuries, just on the price movement. As you see, it stabilized, and in fact, it bounced off. At the end of the calendar year, if you see right on that line that separates 2013 and 14, yields were just right about exactly 3%. And the consensus going into the year was from virtually everyone, because the Fed is tapering, and they were tapering basically $10 million each meeting, so one from 85 to 75 to 65, they're presently at, I believe, 25, and tapering should be done. The Fed purchases should be done, the QE should be done by their October meeting. The expectation was the 10-year and other long rates would therefore go up. How far up, how soon, it's questionable. There were different estimations, but it was nearly unanimous that rates would be going up. And on the way up, rates have gone down. It's been a bit of a conundrum. Why have rates gone down? And there's no one answer, but there are several answers. Answer number one has to do with supply and demand. When the QE first started, the federal budget deficit was well over $1 trillion a year. That's trillion with a T. The federal budget deficit is now less than half that. So while the Federal Reserve's purchases were still $85 billion a month, it was $85 billion off of a much lower amount that the Treasury was issuing. So when they were pulling back, ultimately the market was recognizing that they're pulling back, but there are other buyers to step in because the supply was lower. And so that was one piece. Another issue was that turns out that foreign central banks, for their own reasons, were purchasing U.S. treasuries, including 10-year treasuries and other long-term treasuries. And another important reason had to do with the fact that the ECB, which is the equivalent of the Fed in Europe, Europe is several years behind the U.S. in their recovery. and so they're still on the borderline of recession, arguably. And the ECB is now doing their asset purchasing like the QE that was done by the Fed, except they're a few years behind. And what that's done is the sovereign yields on countries like Spain and Italy, which most observers would agree have less creditworthiness than the U.S., their yields are roughly equivalent to the U.S. So on an absolute basis, on a relative basis, investors looking at, I want to buy a sovereign bond, if you're looking at the currencies and you're looking at the sovereign bonds, you say, well, would I rather own an Italian bond or would I rather own a U.S. bond? And it turns out U.S. bonds, the yields are higher. The answer is U.S. bonds. So investors were purchasing on a relative basis U.S. bonds, and that drove down yields and raised prices. And lastly, because as I mentioned, the consensus was that the yields would go up, there was a lot of fast money, whether it was from hedge funds or other investors who were tactically making investments to bet that rates would go up. When that didn't happen and rates went down, they had to cover their shorts, and that amplified the move down. So right now, while this chart shows 247, because that's when we printed the book, right now it's about in the 250, 260 range. We do still expect, regardless of the fact that rates have gone down, we still expect rates to go up. Don't know when, but it will happen. And when it happens, as it did in the second half of last year, 4+5, your main fixed income program will show negative returns depending on the timing and how much rates go up. Other than that, like I mentioned, risky asset classes did very, very well, as we'll go through the pages and talk to you about. But more than that, if you turn, and I'm now back into the quarterly report, if you turn to page 10, and we talk about this every month, but this is very important, and I'll go through the specifics in just a moment. Take a look at the top part shows the pie chart where we're invested, and the bottom shows where we are versus your allocation, your asset allocation. On the left, you see the green bar that we're overweight U.S. equity. In the middle, you see the light blue and light purple that we're underweight Core+5 and TIPS. It turns out that those three decisions significantly added to your return, because it turns out we were overweight the best performing asset class, and we were underweight the worst performing asset classes. So getting outside of managers doing well or not, we were in the right place, and we avoided the wrong places. So those decisions worked out very well, and we'll go through specifics on that. And we'll tell you about what happened in July when we go through this book, and Scott will have some comments as to what we're doing going forward. But if you're going back now to page 8, the returns, as you see, 1739, and not just that, the quarter ending June was fantastic. Returns were well ahead of the benchmark. So I told you about attribution, I would hint at that. So let's turn to page 14, which gives you a summary of the attribution for the quarter, the year, and 3 years. The top half of the page shows the allocation effect. The allocation effect represents what was the effect of being overweight or underweight versus your policy. So we were overweight U.S. equities. What effect did that have on returns? The management effect, or what they call the selection effect, at the bottom half of the page, describes what did the effect of managers doing well or not well versus the benchmark have. So if you take a look, for the quarter, it was relatively modest on the top. Total allocation effect was 10 basis points positive, and much of that came from what I described before, but it was a modest amount. The really impressive number came from the one-year number. Of the nearly 115 basis points, or actually exactly 115 basis points outperformance, 110 of it came from being in the right place or avoiding the wrong places. And if you look at that, the total domestic equity added 48 basis points just being overweight that. 45 basis points was added from being overweight what's labeled as total structure, which is the total Core+5. And 22 basis points was added from being overweight TIPS managers. The rest of the numbers are fairly modest. Similar results were for the 3-year number. What we don't show here is cash. The 3-year number would show a drag of cash. Actually, all the numbers would show a drag of cash because cash earned something north of nothing, which was obviously your lowest return anywhere. And because of that, holding any cash would have hurt relative to the other asset classes in a bull market. As far as the manager effect, how did managers do versus their benchmark? For the quarter, the results are fairly modest, but it's a positive 5 basis points. For the 12 months, it's also a positive 5 basis points. But I do want to point out that domestic equity did very well. Emerging markets did very well. I'm talking about the managers versus their benchmarks, and we'll go through that in the following pages. And Core Plus 5 did very well. And that offset private equity not doing so well. For the 3 years, it was a very similar story, except that private equity pretty much was the primary driver of actually having a negative selection effect.
And that's predominantly a benchmark issue,
It is a timing issue. Well, it's 2 issues. It's a timing issue, a benchmark issue, but it's also the fact that you do have some private equity funds that underperform. So it's a combination of some funds that did do well, combination of the public markets are way ahead. So for instance, next quarter, private equity is still catching up. So when you see September, it will really be, private equity should show, depending on what happens in September, good numbers, because they're catching up, they're behind, several quarters behind the public markets. So even if well, I'm not wishing the markets to go down, but if they go down, you will have a lag of positive private equity in the bank coming to you because of the lag.
So the benchmark is better to utilize over a longer period of time.
Right.
as comparison.
Right. Looking at private equity or most of your private market asset classes over short periods of time, while it is information, it's not very informative. It's really over much longer periods of time, as our private markets people will talk about when they go into those asset classes. So if you turn to page 15, you'll see that all the way on the left, how did you do versus other large public funds, as on this page defined as funds greater than 1 billion in public funds. Your 408, which was ahead of the benchmark, placed you in the 33rd percentile, so you were in the top third. For the 1 year, you were just outside the 51st percentile, just outside the median. And for the 3 years, a similar story. 5 years, it was just outside the top quartile, the 13%. So I know the actuaries here, and you'll see the 10-year number was in the 35th percentile. Most importantly, the number was over 7.5%. Unless you have any questions, I'm going to turn it over to John Mersberg.
If everybody would please turn to page 20 in the quarterly book. See a summary of domestic equity, and we'll see that the U.S. equity returns were strong for both the quarter and the fiscal year. Fire U.S. equity returned 26.18%, very strong return, and beat the benchmark by 96 basis points. Well, for the quarter, the return of 4.7% trailed the benchmark by 17 basis points. Turning the page to small cap, we see that for the fiscal year, the total small cap composite returned 26.63%, beating the benchmark by 299 basis points. On the next page, we have total mid cap, which returned 27.86% for the year and beat the benchmark by 101 basis points. On the next page, we have the Russell 1000 composite, which returned over 35% and beat the benchmark by just over 10%. On the next page, we have the Russell 3000 passive account that was close to the benchmark as expected for pretty much all the trailing periods. And then finally on the last page in U.S. equity, we have the emerging manager of managers. That composite returned 24.53%, beating the benchmark by 89 basis points. And all of the returns I've mentioned are all gross of fees. Does anybody have any questions on U.S. equity? If not, I'll turn it over to Tatiana for non-U.S.
Let's move up here. I ask you to turn to page 28. Start off with your developed market portfolio. Keep in mind for both IFA and emerging markets, you are more active in these two asset classes, with not over 90% active in IFA and around 72% active in emerging markets. So I'll actually go over some manager-specific performance data while I talk, just to sort of put it through for you. So if you look at page 28, the total IFA, performed by about 23.8 basis points, which makes where you're slightly ahead of the index, which was 23.57. You look at what comprised that was your total active performance was slightly below the benchmark by about 100 basis points, and on passive it was slightly ahead, around 20. Out of all the managers, the two I'd like to point out, three actually. One who did the best was Acadian. They're in your small cap IFA. That's a fairly new allocation that you did in 2012. They're ahead of their benchmark by over 500 basis points. The two laggards were Walter Scott, which was down 824 basis points for the year. We could talk about that if you'd like in the manager discussions later, sort of what was driving that. And then for Thornburg, they were down over 900 basis points. I ask you now to turn over to EM, which is on page 35. Despite emerging markets lagging the overall developed markets in U.S., you saw an improvement in the first half of 2014, and your portfolio did extremely well compared to the benchmark. For the total program, it was up around 330 basis points versus an index that was up around 14.3%. Total active was up 4.6% over the benchmark, and then passive was up slightly. One manager that did the best was Bailey. They're up over 894 basis points. And remember, that's your one fundamental growth manager you have. So if there's any questions now, or we can do later. Sure, the active for IFA is 90, right now it's at 91% for IFA, and then for emerging it's 72%. And now I'll turn it back over to Martin. Do a Neil.
Oh, yes.
Yes.
Can you please turn to page 41? This shows a snapshot and a pie chart of your allocations overall fixed income. It was about exactly 30% of the fund, $3.2 billion, and as you see, it's dominated by your allocation to core fixed income, investment grade core fixed income. The breakdown of that investment grade core fixed income that we call the Core Plus 5 or structured program is on the next page. And we have some good news here, which is while I can't compare with the equity returns, they are still positive returns and they've done well. I want to draw your attention, number one, to the over-underweight column, which is in the middle of the page, on the bottom. As we have been for some time now, we're underweight the Treasury agency sector, which is also known as the government sector, primarily because it has the lowest yield, but it also has the highest duration, meaning when rates rise, you will feel the most pain in that sector. And also it has the lowest yield, so just until that time, waiting, you're earning lower yields, and the other sectors have higher yields, and also lower durations. But the really good news is if you look at the difference column, each of the three sectors outperformed. Of your 12 managers for the quarter, 7 outperformed and 1 was right equal to the benchmark. For the 1 year period, 10 of the 12 managers outperformed, and one of them, Privest, actually outperformed. Of the two, underperformed. One was Privest, which technically did not outperform, but was a timing issue because Privest is it's privately held debt, so they report a quarter behind. So they really did outperform. It's just not shown here because of the timing issues. And similarly for the 3-year period, the other manager that underperformed was State Street, and that's in the government sector. Fisher Francis, which is in the government sector, and it wasn't by much, primarily because there wasn't, number one, much volatility, which managers need to differentiate one security versus another, and they were really limited by what they could do. The managers that did outperform in that sector didn't outperform by much. So how did the program do as a whole? That's on the next page. 16.5% of your program is in this program. It's the largest fixed income program. A couple of items of note. For the quarter all the way on the left, the return was 2.8%, and that was 20 basis points ahead of the benchmark. I mentioned to you that most of the managers did well. But the really impressive number was the next two columns, which is the fiscal year to date in 12 months. They're both the same, obviously. The return of 6.55% was 100 basis points ahead of the benchmark. I've said this before, but an asset class that has low expected returns or relatively low returns, even when it is positive, is very, very helpful that managers do well in that environment to add value to an otherwise low expected return asset class. You'll also notice that going out to the longer periods of time, the returns are similarly in that area of 5 to 6.5%, but also well ahead of the benchmark for all of the periods. This is a program that's done very, very well, and the fees are low as well. Last item on this page that I want to draw your attention to is on the bottom, which is the volatility. Those numbers on the bottom. So pick a number, take 3 years. The return that you had for 3 years was 532. The return for 5 years next to it was 668. But the volatility that we had in this program for 3 years was in the mid-threes, 3.5%. For 5 years, very similar, 3.5%. What that means is it was slow and steady gains. Even during the few months that we had volatility, it was nowhere near the equity volatility, and while the volatility increased, is of a different order of magnitude than what you see on the equity side. When rates rise, obviously there will be more volatility, but that volatility is of very, very different magnitude than what you see on the equity side. So good news for the Core Plus 5-year largest program. The next page is your Developing Manager LM. It's labeled Core Plus, but it's really just a single manager LM. You hired them several years ago after the last search. And LM, just like the Core Plus 5 managers, effectively LM is all sectors in one. Plus they do a little bit more, that's why it's called Core Plus. They do some emerging market debt and they do some high yield. Not only did they outperform, but they outperformed again for the 1 year by 100 basis points. If you look at the 5 years, by 125 basis points. So they've done really, 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 really well. Just so you know, there's a new search out for, of course the contracts are expiring. There's a search out on the street now for developing managers. And you'll be hearing about that from us in the coming months. The next page is Progress, which is our emerging managers, which are even smaller managers. Progress is a manager of managers. And similar story, they're newer than LM, but nevertheless, the 1 year number was just as good as our structure program, and LM's number over 100 basis points ahead of the benchmark. TIPS is on the next page, on page 46. This is an asset class that we have. Number one, we're underweight tactically, that Scott will talk about a little bit more later. And we also, since the contracts are expiring and have no further ability to extend it past March, we're doing the search right now with the help of NEBC, and we'll have a report for you going forward, probably by the end, certainly by the end of the year. Dates unknown, but probably November, December. December's more likely. The year, the quarter, the year, and all the other numbers you see here are positive. For the quarter, the results were 372, 9 basis points behind the benchmark. For the year, was 464, 20 basis points ahead. Just to give you an idea of how volatile it is, people think of TIPS as just being inflation protection. But it turns out the biggest driver of returns, because you can ask me, well, Martin, did we have 4.6% inflation? And we do have a chart in here that shows, in this book, that shows inflation over the last year was 2%. So why did we earn 4.64%? And the answer is the volatility, and the reason the volatility numbers are higher than Core Plus 5 comes from duration. There are two drivers of returns, main drivers of returns from TIPS. Number one is inflation. So inflation goes up, you get paid for that, as laid out in the securities rules. But the securities themselves have a very, very long duration. What that means is when rates go up, you lose money. So think of it as having about a 10-year duration, a real duration. But even in nominal terms, it's a very, very long duration. And in the second half of last year, when rates went up, TIPS got crushed, and if you recall, the returns were very negative. The first half of this year, as you saw from the chart that I showed you before, the 10-year Treasury, rates went down from 3% to approximately 2.5%, and it was basically across the board on a long-term basis, long-term rates. Short-term rates had similar but more muted responses. And because we had such a long duration portfolio, the TIPS portfolio benefited from that. And so we made up the loss and then some, and so we ended up with a 464. We presently have a mix of 3 managers, and we'll be bringing to you a recommendation for that after we work with NEPC, and we are working with them right now as we speak on that. This program goes out 9 years. You see the 3 and 5 year number. The program's added about 20 basis points since inception. In case you're wondering, fees are less than 10 basis points, so we're net of fees. These are gross of fees, net of fees. We're still ahead on an active basis. And we'll be talking more about that when we bring you the results of the search. Next page is page 47, and that shows enhanced yield, which is our code for high yield. Most people call it high yield. This really did very well. We have a program that's a couple of managers, that's I believe 3 managers. We have balanced portfolio, aggressive managers, Luma sales, defensive managers, and another manager that's a core manager. So that one manager is zigging, the other manager is zagging. It's been a bull market. As you see, the 5-year return is remarkably high for high yield at 12.45, which by the way was still well ahead of the benchmark. Or 25 basis points, I should say, ahead of the benchmark. Remember, we did a search for this 2 years ago, so we revamped your lineup, and that's why from the 3-year numbers and beyond are really old manager numbers, aside from T. Rowe Price, which stayed on because they did very well. But if you take a look at the quarter and the 1-year number, the 1-year number at 12.03 is well over 100 basis points ahead of the benchmark. And the program, we're very proud of this, has done very, very well. For the quarter, 2 of the 3 managers outperformed. For the 1 year, all 3 managers outperformed. It's a program that's done very, very well. And quite frankly, the mix of managers that NABC and BAM recommended to you and the board approved, you should be very proud of the mix of managers that we have. This is a program that's done very well, gross of fees, net of fees. And compared to the universe, we're doing very, very well. Bank loans is the next page. That's the newest of the asset classes that we did. We did it alongside of high yield. We would expect that the returns for bank loans would be less than high yield for the simple reason that bank loans are higher in the capital structure. So in exchange for being higher in the capital structure, since you are safer if something goes wrong, you have lower returns. And also the returns are based on floating rate notes. So high yield managers, while they don't really generally have views or work on duration interest rate moves, they benefited from interest rate moves. Bank loans are based off of floating rate LIBOR. LIBOR didn't move much, so there was no benefit of interest rates of duration that, generally speaking, that the high yield managers had. So the returns for the quarter were behind the benchmark of your 2 managers, both underperformed, but modestly. And for the year, we were 67 basis points, and both managers outperformed. But I can tell you that the return for the year, which was 12% and change for the high yield and nearly 7% for bank loans, is pretty much what we would expect to see going forward. Bank loans a little bit less than high yield because of where they are in the capital structure. And that's why we want bank loans, because we have diversification instead of fixed rate. We have floating rates. Rates go up, not only don't we get hurt, but we actually get helped, because if short rates, while we're not expecting when rates go up, it'll affect LIBOR, but at some point LIBOR goes up, that will benefit. Rates going up actually benefits the portfolio. And as long as the managers pick the right credits, we won't be hurt by credit issues with rates going up. Because remember, rates going up, well, it's good because you're earning a higher rate of return. It's bad for the manager. It's bad for the underlying credits because it makes their cost of capital go up. So prices will initially go down, but then the market will equalize and equilibrium will take over once the market recognizes that. Next page is convertible bonds on page 49. This is all Advent. For the quarter, they outperformed. Remember, Advent convertible bonds is very, very highly correlated to equity. To give you an idea, it's about 70% of the upside and about 40% of the volatility. Advent themselves, they're very defensive, so they're very bond sensitive. So the return was very good compared to the blue, the light blue, versus, which is their individual benchmark. Benchmark for the program is gray. It looks terrible compared to that. But since this has been a bull market, once, and again, second time I'm saying this, we're not hoping for the equity market to go down. When the equity market eventually goes down, that will turn around, and Advent, because of their defensive nature, will do well. And the proof of that is in 2008, they were not just several basis points ahead, they were many, many percentage points ahead of the benchmark. And as you see, during all the time periods, they're ahead of their individual benchmark. Opportunistic fixed income is on page 50, and that's the star of fixed income. We'll be talking more about that in executive session when we go over our annual plan. The return, quite frankly, has to be double-digit returns net of fees, and they haven't. For the fiscal year date 1355, the 3-year number and the 5-year number, while the 5-year number is good and the 3-year number is a little bit behind the benchmark, are less relevant, and we'll go back into this and describe why in the executive session when we go through the annual plan. But really, we're at an inflection point where old funds are rolling off and new funds are coming in, so those numbers are less relevant to the information going forward. But obviously, the numbers are what the numbers are. And I'm going to turn it over.
We skipped over REITs and hedge funds.
So REITs, I will tell you, has done very well. And REITs has done very well for the simple reason that it's very tied to interest rates. And as interest rates go down, the cap, so to speak, the cap rates go down, and that benefits REITs. They're very highly correlated to long-term interest rates. And your managers have done well, and I'm not sure if Yvonne has anything to add to that. So that's sort of
Neil, we'll get your quick report on hedge funds before we move to the rest.
Yeah, hi, good morning. I have just one slide, so I should be quick. But I actually think it's a really good slide because it tells you a lot. It's page 39, and it's hedge funds. And there's 4 bar charts on here. And just taking the 2 in the middle are the same, and the ones on the end, that's the trailing 3 months is obviously the last quarter, and then the trailing 3 years is the hedge fund program since inception. And one of the things you've probably heard us say over and over again about the hedge fund program is that while we're building it out, we've been out of balance in terms of, we've had some money in some strategies and some money in other strategies, and it's going to take us a while to get to the point to where we're balanced. Well, we're much closer now, and so you can see that in the performance in trailing 3 months, right? We're, now that the portfolio is closer to balance, we're outperforming both benchmarks, and if I'm doing a good job in the future, that should continue to be the case. The next 2 bar charts are the fiscal year to date and the last 12 months, which are the same thing. And you can see that this shows you some of the portfolio being out of balance, right? We were, prior to making a couple of investments that recently put us more in balance, we were outperforming one benchmark but not outperforming the other. And the last bar chart is the hedge fund program since inception. And I say that this bar chart is important because even though the hedge fund program has been out of balance since the start, we are still keeping up with both benchmarks. And so that gets us a little bit excited about future hedge fund performance because now we are in balance, and we hope that the trailing 3 months bar charts are more of what you're going to be seeing in terms of our performance compared to the benchmarks.
Thanks very much, Neil. Okay, now we can move to
Scott, there's actually marketing.
Sure. Go ahead.
So it's only towards an enhanced yield. The 3-year standard deviation between the plan and the benchmark spikes. They've kind of been tracking each other very closely, kind of over a longer period of time. I'm just wondering if there was any particular reason for that.
Hold on, please. Yeah, just like with 4+5, you should expect that the volatility will go up going forward. But what's happening is it's been a slow and steady. There's been tremendous fund flows in the ETFs, inflows, and it's been a slow and steady. There's only been a handful, barely a half a dozen down months in the asset class. It's been slow and steady. So probably after QE, we'll start getting some bumpy months and normal volatility will return. So those standard deviation volatility numbers are being aided by the QE program and the market environment that we're in. Going forward, you should not expect to see such low volatility numbers. They should be going up.
It's really true for all asset classes, for the most part, that the 3 and 5 year have been below any kind of trend that you see over 10 years and any assumption that you would use when we do asset allocation modeling. So for example, high yield, that 10-year standard deviation is 8%. our assumptions, when we do modeling, we use 12. So I think it's 12 and a half, but it's a much higher number. And we do expect it to revert to trend at some point.
Okay, any other questions on the public asset classes before we move to more of the private? If not, we'll move to the forward drawing book to talk about ETL.
Can everyone hear me? Am I loud enough? All right, still project. All right, starting on page 51, I actually need to correct some numbers on our overall ETI chart. State Street averaged out our returns and did not weight them in this chart, so we're working on ensuring that doesn't happen quick in the future. For 3 months trailing, our return was 2.64, not 2.61. For fiscal year to date in the 12-month trailing, it was 4.97. For the 3-year trailing, it was 3.82. 5-year trailing, 4.60. 10-year trailing, 5.07. And 15-year trailing, 5.79. So overall, we outperformed our benchmark on every single measure. We're up around 59 basis points for the last quarter and 76 basis points for the last year. Switching a little bit to this book, I'll walk you through just the 4 programs very quickly, starting on page 7 and 8. Our PPAR program, this is the long-term loan program we give that we run directly out of the office. We had a really good quarter. We're up 242 basis points, and we're up 973 basis points for this fiscal year. Now, I would like to take credit for this happening right when I started. I can't actually do that. What happened was when we switched to State Street, we reevaluated all our loans with a new outside consultant as part of the process. And on the plus side, our loans are actually a lot more valuable than previously thought by the last consulting bank. In part, that's because we've benefited from the falling interest rate market and the number of loans that we have that were above that. To give you a sense of what we've been able to do over the last quarter, we have issued loans that will directly create or preserve 120 units of housing. And we've committed for another 726 loans that are new over this last quarter. Right now, we have roughly 2,606 units invested since FIRE entered the program. Going to the next page, page 9, AFLO-CIO HIT. This is the mutual fund we're invested in with the other large pension funds across the country. It outperformed its benchmark by 36 basis points for the quarter and 8 basis points for the fiscal year. So far, it's invested $454 million in 9,435 units of housing. And since inception, it's created 21,000 units of housing, actually almost 23. The AFLO-CIO HIT Workforce Program on page 10. This was a separate fund created by AFLO-CIO to invest in Fannie Mae security for Penn South. We have $45 million in there right now, and so far it's working to improve those 7,656 units with duct work, heating work, and laundry, and it's performing on improved laundry rooms and things like that. It's improving on a good basis. And Access Capital Strategies on page 11, it outperformed its benchmark by 79 basis points for the quarter and 84 basis points for the last fiscal year. This is where we invest in Fannie and Freddie and other securities, focused a lot on single-family homes. In this second quarter, we've done 237 single-family homes. For the past quarter, in a multifamily home investments, we've done 111 units. And since inception, we've put about $32 million in there to create or preserve 33,882 units of housing. I mean, I'm happy to answer any questions if there are. Thank you.
If not, we move on to the private equity team, talk about the fiscal year results.
Good morning, my name is Rafiq DeCastro, and I'm going to present the quarter ending 3/31/2014 private equity performance. I'll turn to page 27 in the large book. This is your performance book. There's a lot of information on this page, but I think what's important to focus on is the left column titled March 31st, 2014. If you notice, what's important here is the $1.3 billion in active commitments to the fire portfolio. This represents about 85 managers or about 135 funds, representing a market value of about $664 million, unfunded commitments of about $488 million, which in total gives you exposure to private equity of about $1.2 billion. If you notice from the end of the year, December 31st, 2013, you made one commitment in the quarter. This is to a secondary manager, Lexington Partners, Capital Partners, of $40 million. But overall, for private equity, you were very active after the end of the quarter, making 3 commitments to 5 different platforms: a commitment to AXA, now known as Ardian, a commitment to Crestview, and a commitment after the end of the fiscal year to Vista Equity Partners. What's also important on this page, on page 27, is at the very bottom, when you look at your overall total portfolio, you'll notice that your since inception return is 11%. You'll also notice that your total value multiple is about 1.37 or about 1.4 times your value. This is important. If you turn to page 29, you'll sort of get a comparison of your overall benchmark. And the way to think about your benchmark, as a reminder, is really your opportunity cost of investing in private equity versus invested in public stocks or the public market. And what we've done is we've come up with a public benchmark of the Russell 3000 at a liquidity premium of about 300 basis points. And if you look at that since inception number I mentioned, the 11%, you notice that you're slightly below your overall benchmark plus a premium of about 2 percentage points. But when you think about private equity and the life of a fund of about 10 years, it's also good to look at that 10-year number. You'll notice that you're slightly improving. You're only about 1.7 percentage points lower than your overall benchmark. And then when you look at your 1-year number, you'll notice that a strong uptick in relationship to the overall public markets. But also another important point is to go to page 28, which is just the next page over. And what you'll see there is really an improvement in your overall performance, started in the later vintage year, the most recent vintages, about 2008 and up. You'll see that when you compare your private equity platform to the overall benchmarks or measured benchmarks to your platform, you'll see an improvement. And what this says is that your portfolio overall is on the right track. It's improving to the overall benchmarks, and obviously in good shape. And going back to page 29, let's think about what's the key drivers to those most recent performance. If you look at the bottom of that page, on page 29, you'll notice that you'll see some very high marks or high performance marks, IRR marks, to the large buyout space. Large buyout space is your investments to names such as Apollo, recent investments to concentrated bets to names such as Apollo, recent investments to secondaries at about 20.5%. This is to names such as Ardian, to Landmark. Strong performance to the growth equity sector of about 19.5%. This is to names such as Vista, and also strong performance to the special situations bucket. And these are names such as Platinum Equity. So once again, you're headed in the right direction. The private equity performance is overall improving. If you go to page 31, you'll get an idea of the overall diversification of the portfolio and sort of how that's shaping up to the plans that you've come up with. So if you notice here, you're very diversified. There's an outweight to the global, to the buyout sector, which is slightly below your target, but on track to hit the target. However, if you notice certain sectors such as special situations, co-investments, and energy, you'll notice that you're on the way to those sectors. Later in the executive session, we'll speak to a plan to get back on track in those particular sectors when we review your overall annual plan. If you notice the geographical focus, you'll see that your portfolio is in large diversified across different geographies. North America is about 58%, global managers are about 33%, Western Europe is about 7.8%, and the rest of the world is about 1.1%. Let's finally turn to page 33. And I think this is one of the key components of your portfolio, key points. This is really about your cash flows. And if you notice here, you'll notice the trend line on the quarterly cash flow activities, that the trend line is slowly ticking up. And what this says is that your distributions are beginning to outweigh your overall contributions. What this means is that this is a good thing for your portfolio. It means that your portfolio is becoming self-funding, which is sort of the goal of most private equity portfolios. If you turn to page 34 quickly, you'll notice that this trend is in line from prior years. It's trended in the right direction. So overall, I would say that it's good. Your portfolio is in good shape, and that's the review of the private equity quarterly review.
Why don't we turn to real assets first to Ron Nelson?
Great. So on page 43 of the same book that Felix just went through, we'll go through the real estate performance for the first quarter, which is part of the real asset class. As you know, that was reconstituted in 2012. So real assets now is comprised of real estate, infrastructure, and other investment strategies to come. But just to give you a highlight over the achievements for the fiscal year, and it's actually a 12-month period ending March 31st because there's a lag in real estate in terms of performance. So for that 12-month period, FIRE committed and closed on about $115 million of new investments to 5 investments, and that's consistent with the annual plan and our objective to enhance the diversification of the portfolio. In terms of performance, that's good news. For that 12-month period, the real estate portfolio for the FIRE system delivered a return of 16.2%, which was 220 basis points over the benchmark. So now I'm going to speak from page 43 about the performance of the portfolio as of first quarter 2014. So we talked about the real estate allocation being 5% for the FIRE system. That would represent about $515 million. In terms of real estate and the market value of what we have in the ground today, is close to $400 million at $390. We are busy. We talked about the 5 new investments we did just within the past 12 months. So we do have commitments out there that we have yet to fund, and that would constitute about $150 million. Together, the exposure to real estate for the FIRE system is close to $550 million at $540 million. That portfolio is global in nature. We have about 43 investments at this point, and we have about 33 managers that are hard at work executing both core and non-core strategies. And I talk about core and non-core strategies because in conjunction with the investment policy that we set forth for real estate, the portfolio is a blend of core and non-core strategies. We are looking toward having a mix of, at least 40% in core strategies and at least 40% in non-core strategies. That kind of gives us a 20% bandwidth to kind of move with the market and execute strategies where we see more compelling opportunities. At this particular point, the portfolio is skewed toward non-core. It's about 34% core and 66% non-core. We're going to be talking at length later on today about the annual plan, but I think you may recall in previous annual plans, particularly right after the crisis or as domestically we started to emerge from the recession, we saw opportunities in the non-core space, and there was an overweight at that time to non-core strategies. Now, in terms of being an alternative asset class, and when you give these managers money, particularly in real estate, it's a fund. Typically, it's a 10-year finite life. Maybe it's 12 years. But what's important is that the manager is not or should not be deploying the capital all at once. There's typically an investment period where the manager is deploying the capital, typically in about 3 to 4 years. So although we have this overweight, and particularly is toward the commitments that we've made in 2010 and later, we expect that that'll start to normalize over time, as these managers deploy the capital. If we look over to the lower right, there's a bar chart that depicts the performance of the fire portfolio in real estate over various periods. For the quarter, we were closely matched. Again, we talked about the 1 year and the good result that we had there. Again, also in the 3 year is positive over the benchmark by about 20 basis points. This is consistent with what we talked about earlier in terms of the commitments that we made in a post-recovery environment, the vintages that we've committed to in 2010. In the longer periods of time, you kind of see the results of some of the commitments that we made to managers that kind of struggled during the global crisis, and also the timing of the commitments that we made in those earlier periods. There was a peak year of commitments in 2007, right before the crisis, so unfortunately that class of managers struggled, and we see that in these numbers. But in closing, we're going to be talking more in depth about real estate later on in the annual plan. The portfolio is well diversified. We're about 12.5% international, trying to get to that 25%. And so if there's any questions, I'll take them and look forward to the conversation that we have later on.
Good morning. This is the first performance report for infrastructure. As you recall, the infrastructure program was adopted a little bit over a year ago, and for 1 full year we have been making investments. It's very early in the program. Fire invested, or rather committed, $35 million over the last fiscal year, $2 million of which have been funded. So again, very early in the program. The commitments are to 3 best-in-class managers in core strategies, again, as called by the program. The returns at this stage are not very meaningful, but they're still good. They're around 12% gross and 9.6 net. One important consideration is that cash yield for the first quarter has not been that high. It's less than 1%, but in the second quarter we already start seeing 6% cash yield. So the trend is good. The managers are doing what we expect them to do. They're investing. And this concludes my remarks. If there are any questions. Thank you.
All right, Martin, I'm going to turn back to July performance review to give you some of the short-term stuff. And we're going to update on what happened since July. We're going to talk about rebalancing, and then we'll go on to something else.
Anyone need any copies of the book? Good. So as I mentioned before we started as we began the quarterly reports, where we were in the economic cycle, the recovery is ongoing, but recovery is slower than was hoped for, and people aren't feeling it as much. And one of the pages you can turn to that shows that is page 6, Consumer Sentiment. It's done on a monthly basis, and the one we chose was the University of Michigan, which is one of the more commonly referred to and more thorough research studies on a monthly basis for consumer sentiment. And while the number looks on this chart for the past 5 years is high, which the number is 82.5, if you go back in history, where we are in the cycle, in the recovery, this number should be well above 100 typically. And that's the reason it's not, is because people are not feeling the recovery. So if you take a look at the unemployment rate, the page before, 6.1%, definitely an improvement. You see the change. The problem there is the headline unemployment rate. If you go on the Department of Labor's website, there are several different unemployment rates. The unemployment rate that is the headline rate, which is quoted most places and which we use in this chart, removes discouraged workers, removes workers for various reasons. And so the true unemployment rate, if you include people who are no longer working for a job or working part-time or aren't fully working where they want to be working in their desired field and so on, is much higher. In fact, it's in the mid-teens. So that's why people don't feel it. Also, wage growth has stagnated. And so while the unemployment rate has improved, while people who are working are not seeing, except on the top end, they're not seeing, the middle class is not seeing important wage growth in their personal lives. So it's a mixed picture. On page 4, weekly unemployment claims, which is a very important number because it shows how many new unemployment claims, and you see the chart is showing the right direction. But nevertheless, that 302,000 unemployment claims for the week, which was the week before, while an improvement at this stage in the economic recovery, which we're 5+ years into, should be better than that. A couple of other slides I want to bring your attention to. Page 18, the VIX, the volatility index. Page 18. We had a question before from the mayor's trustee about the volatility. This is a volatility chart that refers to the U.S. equity markets. And as you see, the number is at 13, and you see that while it's 5 years, you see the trend is downward. Typically, when the volatility number, the VIX, goes down, it's usually a signal that the next move, in other words, everyone who wants to buy has bought, and the next move is down. It's a contrary indicator when the VIX number is very low. Why? Because the VIX is calculated using puts and calls. So when people are complacent, when people are comfortable, they're buying fewer puts. Why are they buying fewer puts? Because what is a put? A put is if their security goes down, you have protection. Effectively, it's insurance against your individual holding or an index of some sort. When people or investors are buying fewer puts, it's an indication that they feel very comfortable and are bullish on the equity markets, which means that people who are buying without the protection that they ordinarily would have, or everyone who wants to buy has already bought. So that's why partially why it's a contrary indicator. The 10-year Treasury we've gone through, it's on page 20. How about the markets? How are they valued? So page 21 shows investment grade and high yield spreads, and you see this goes back 15 years. And the reason we did 15 years is to show you the data points. Obviously, 2008 stands out. We had to change the scale of the chart to give room for what happened in 2008, where spreads grew out. Spreads effectively are what is the yield of a fixed income instrument above the Treasury, equivalent Treasury maturity. So if it's a 10-year corporate bond and Treasuries are trading at 250, if a 10-year, I'm making up a number here, if a 10-year corporate issue is trading at 350 yield, that's 100 basis point spread. The blue line is for investment grade and the red line is high yield. As you see, both are low, both are historically low. In fact, investment grade is now below triple digits. While it can be below, as you see in the mid-2000s, last decade. They were below that for several years. It's simply a sign that investors are putting a lot of money, whether it's institutional money or whether it's individual money, fund flows from mutual funds, into these asset classes because they need to find yield. And that's especially true with high yield. The spreads that you see here, based on this number, which is the beginning of the month for September, was in the 360s. That is historically low, and when you add on what the Treasury yield is, high yield, it's not really high yield anymore, it's higher yield. So while on an absolute basis is low, on a relative basis, in this part of the cycle it's reasonable because it's really compared to what defaults are expected. And defaults are very low. It's really only a few headline defaults and a few small defaults. So the reason you have a spread in high yield is to compensate you for the possibility of defaults. The defaults are very low. Next page shows, page 22, shows the S&P 500, the earnings, and the PE ratio. So the earnings is in the white line, and it keeps going up. That's good. And you may have read articles or heard that companies keep earning record earnings, but they're not hiring. So at some point they will be hiring, but they're not yet. And so they're either returning the cash to shareholders or keeping it on their balance sheet. And so the earnings are good, but the PE keeps going up. So that's the number in blue, and it's 18. That historically is high. While it's in the range of being fair, it's on the high end of being fair. So we are entering, after all the money that's been shoveled into equity markets in the U.S., we're entering into a period of time where if the equity markets keep going up, it becomes overvalued on a fundamental basis, historically. How does, on the next page, the equity markets break down large cap, mid cap, and small cap? You see that the PE ratios for, and this is the numbers we're showing here, are forward-looking. So you take it with a grain of salt because we don't know what this is forward-looking by the analysts. But what you do see is that the PE ratios, the next page is US, IFA, and emerging markets. You see that emerging markets on the bottom is lower, which means it's cheaper. IFA is in the middle, and US is higher, which means on a relative basis, the more attractive investments are in the emerging market space compared to US or developed markets. Within the US is on the next page, which is the large cap, mid cap, and small cap. Small cap, you can argue that the PE ratio is extremely high. Mid cap, it's high, and small and large cap, it's on the high end of average. So as I said, it's in the high end of fairly valued. The numbers on page 25 show what the returns have been for the past year. So Russell 3000, as you see in white, is the U.S. equity market. It's over 23%. And the developed markets, IFA, and emerging markets, shown in orange and yellow, respectively, are lower, but the returns are still good in the mid-teens, but they are lagging the U.S. market, and that's why the valuations in the U.S. are not quite as compelling going forward. So how did the returns show in July? Show up in July? Well, we just talked about a fantastic June and a fantastic fiscal year. I don't want to blame it on our new CIO, but the returns for the month of July were not good. The equity markets were down. If you take a look at the first column, which is, by the way, the same as the fiscal year dates, this is the first month of the fiscal year. In the Russell 3000, the first column, was down nearly 2%, the equity markets. Next set of numbers, the IFA, the first number, was down the same exact number, minus 197. Emerging markets, interestingly, were up 1.9%. The other numbers were also down. 4 plus 5 in the last section on page, I don't know what page that is, but it's on the page, the July numbers, was down 27 basis points. High yield was down 1.3%. Even bank loans were roughly flat, down 4 basis points. Convertible bonds were down nearly 2%. So if you now skip to what did the fund do in the month of July, you skip down to page on the top right, page 31, the return on the left for the fiscal year, the very first month, was down 97 basis points. And you see the reason was mostly because the contributions are mostly from the U.S. equity market, which is 84 basis points, and IFA, which was down, which affected it by 20 basis points. Fixed income were true diversifiers in the month where we did have some positive numbers. So while the number was for July was not good to start the fiscal year, if you now turn back a page, you'll see what happened in August. Well, we don't have the full numbers for August. I can tell you what the market did. And the answer is the market rebounded, and rebounded to the point that it not only made up the losses in July, but we're now positive. So in the first set of numbers, you can see the 1 month number for the Russell 3000 at 4.20%, bringing the fiscal year to date up to over 2%. EFA was down, but down only a fraction, 15 basis points. Emerging markets continue to go up over 2%. Core plus 5 was up over 1%. On the next page, you see high yield was up. Bank loans were up. TIPS were up. Convertible bonds were up. So we now estimate that your return is back to where it was at the end of the fiscal year, and actually a little bit higher. And the market value is very close to what it was at the fiscal year end. So I won't give you a number where we are for the return for where we are now, but we're definitely, we believe, positive or very close to being positive since we made a return in the month of August for what we lost in July. The next important chart would be on page 33, which is where we are in our allocations. I'm going to turn over to Scott for that.
Great. So I'm going to ask you to take a look at 2 pages from 2 different books. So the first is page 33 from the color flip book that Martin was just on. Keep that open, and then go back to your quarterly book and pull up page 10. And so what this is going to show you is the same chart, just different snapshots. One's at the end of June, the other's at the end of July. And you can see what we're beginning to do to the portfolio. If we start with page 10 in the big book, and we look on the bottom panel all the way to the left, the green box, that's our U.S. equity exposure. And the 5.6% means relative to our policy, being 65%, like 65% in equities, within U.S. equities, we're 5.6% over. And you can see we're right up at the top of the bracket, which means we're, sort of at a maximum overweight, without having to come back to you guys and ask for special permission to go over. So we're right up at the maximum level of aggressiveness. In the most aggressive asset class, in an already aggressive portfolio, in a market that, as Martin just went through, is looking a little long in the tooth in terms of the performance of risky assets relative to the rest of the market. And as he went through asset class after asset class after asset class, you can see that we're not getting paid what we are normally paid to take extra risk. The PEs and equities are quite high, particularly for the riskiest part, the small cap stocks. The spreads, the extra return that you get from high yield bonds or from long dated bonds are not what we're used to. So we're not getting paid to take risk. Now, we will, as a matter of policy, take a fair amount of risk in this portfolio by virtue of the asset allocation. But this is looking at, are we taking extra risk in the portfolio? And it's no longer a good time to be doing that. So we're going to start rebalancing the portfolio to not take extra levels of risk. And if we were just on policy, all these numbers would be 0 across all the asset classes. So that gives you a sense. So the green line, you'd expect, the green box, you'd expect to go down. And that's June. Now we flip over to July. Page 33, you can see at the end of July, it's down to 3.7%. So we began to rebalance. Martin and I started talking about it, I think the second day I was here, and we've continued to rebalance the portfolio. We're now below 3.7%. I can talk in more specifics in the private session if you want. But it's, you'll see us rebalance on a more frequent basis, not a regular basis, but a more frequent basis as we go forward. Philosophically, if you're going to do tactical asset allocation, the best tactic is to be a rebalancer. To buy assets that are doing unusually poorly and sell assets that are doing unusually well in the expectation over time they'll regress to our normal expectation. We'll do that across asset classes. We'll do that within asset classes. It's a philosophical thing that's shared by many successful investors over long periods of time. This is just a little example of how we're doing it, and I can give you more details in the executive session. Okay.
The next page after the chart on page 34 show basically the page before, but all the numbers and percentages. And it also shows what the actual policies were. The adjusted policies, as you know, we have so-called parking places. So we're underweight in opportunistic fixed income or real estate. Where does that money go? It goes into, by rule, into certain other asset classes like the 4+5 or U.S. equity. And all that is laid out on pages 34 and 35. So what was the market value? I told you July was negative nearly 1%. So it brought the return, the market value, which was 10.7 billion, down to just under 10.6 billion. I can tell you now that we're probably back up to the 10.7 billion as of right now because of the good August that we had. That's on page 37, which is a month-by-month market value chart that shows what happened over the last year. And as you see, there were only 2 down months over the past year. We went from 9.3 billion to 10.7 for the fiscal year. And the really good number that I have for you is that that's when you're looking for something, you'll find it. The amount of money that the pension fund added for the fiscal year was $1.5 billion. So if you take a look at what the pension fund was 1 year ago, at the end of fiscal year 2013, and take a look at where it is at the end of fiscal year 2014, the market value increased by $1.5 billion, which is a big number on a pension fund that's about $10 billion. So it was a combination of the good returns, a combination of being in the right places, avoiding the bad places, and the city making their contributions. So everything worked out very well. The next page shows, on page 38, shows the 10-year chart of each fiscal year where we were. And the good news for the actuary and all the trustees is that the 10-year number through July is 7.8%. That's the annualized number for the retirement system. Next pages, starting on page 39. 39 is a summary page showing each of the main asset classes with the returns for the different periods. And the following pages show each individual manager with their return versus their benchmark in green and red, whether they outperformed or underperformed. And the pages after that show private equity and real estate, what the market values are, what the cash flows are, what the money came in and when the money came in or whether the money went out. So those are the end of my comments for July. And the hint about August. We'll obviously have more information about August next month and in detail, but if you have any questions, I'll be happy to take them.
We have one final item for the public session, which is the variable.
You give me the firefighter. Variable supplement. So what we should do is, we should take a motion to exit this public session, but then enter the public session for the firefighter variable supplement. Is there a motion?
So moved.
Second.
Any objections? Hearing none, motion passes. We also need let me just roll call.
Thank you, Mark.
Carolyn Wolpert.
Here.
Susanna Vickers. James Slennon.
Here.
Eddie Brown.
John Kelly has any Brown's project.
So we have obviously a report for this, so we can start that part of the meeting.
Thank you. So I'm going to invoke this the firefighters ESF quarterly report. On page 3, it shows what the returns were. The return for the year was 17.66. The market value was up to $424 million. I know we've already gone through the economic background and the market value and the information about the different asset classes. So unless you have any questions.
We reviewed the report, it's satisfactory. One question to follow up on the last time we talked about this, the actuary, has there been an update to the possible skim?
It looks like there is a potential skim payable from fire to the 2 variable supplements funds. The amount may be quite significant, but we also need to do a determination whether or not the ABO gate actually might come into effect here, given the size of the potential transfer. And so our office is working on that, and we hope in the near future to be able to provide numbers to the city and to you to be reported as preliminary in the financial statements, and then the details will be developed over time as all the numbers are finalized.
Thank you both for those. Sorry to your question. See you, sir.
Okay, then we now need that's it for that.
Yes, that's all.
We need a motion to move out of the public session of the firefighter variable supplement meeting and move into the public session of the fire officers variable supplement meeting.
Second.
Any objections? Hearing none, motion passes. So we need a, let me call that again. Let's see. I can't hear you. Well, no, we're going into the public session of the fire officers. Even though the comment there by the actuary was relative to both, I think. I'm not sure. I think we have to do that part of it. Then we can take all right? Okay, let's see. So I have to, let's see. James McGowan, roll call.
Yeah.
Paul Ferrero, I'm sorry. Then we also have Carolyn Wolper.
Here.
And Susanna Vickers.
Here.
Okay, so we have a quorum for that, so go ahead.
Thank you. So I'm on the book, the quarterly report that on the front is labeled New York City Fire Officers, VSF. The return, if you take a look on page 3 for the fiscal year, was $19.59, and the market value as of June 30th was up to $306 million. We went through, as I mentioned before, for the firefighters, VSF. We've gone through the macroeconomic background and the different asset classes. So I'm going to ask, do you have any questions about the report?
No, we don't have no question. We looked, all right, we looked at on the book and everything looks okay. So we accept the report.
Thank you. That's all I have.
Okay, I think we do the motion first. We need a motion to move out of the public session, adjourn the fire officers variable supplement meeting, and a motion to resume the New York Fire Department Pension Fund meeting. Is there a second?
Second.
Any objections? Hearing none, motion carries. Roll call remain the same. At this point, I think we're going to go into executive session. We're going to have a motion. Is there a second?
Second.
Any objections? Hearing none, motion carries. Would the cameras be turned off at this point, please?